time. Truthfully, though, we're looking at them about an hour before the presentation, and I think we're going to have to break this up because we've got tons of great questions,
Yeah,
frankly.
some questions were multi-parters. We had more than 50 questions come in. So behind the scenes, we've been planning to do a long-term care arc for a long time. And I think that's going to get pushed back further because we're going to do a few episodes now just trying to work through the questions. So if we didn't get to your question today, and some of these questions are paragraph essays, so they need to be parsed down a little bit and not just read live on the air. But we'll do a few episodes with Q&A, but we'll get started with some of those questions today and also keep track of questions that come in through the YouTube channel itself.
And it's funny, huh? You could tell that our listeners, readers, what have you, are a different breed. This is not your mother's financial planning podcast. It seems it's pretty in depth. So we'll get cracking. There really won't be time for small talk. Wade, what do you think about that?
One of the questions I did see enjoyed the small talk, but we're not going to get an expose on what all Alex did during the New Year's, other than I hear there's been a lot of push-ups and a lot of pull-ups.
Well, we're trying, man. We're trying.
And cold plunges.
Well, that too. The kids too. The kids actually, they did like 30 days in a row. So it was they did it even. So that was good to see.
The cold plunge? Or
yeah. Okay. That's the cold plunge. I just, we have like a horse trough. We just put it out in the back and we get in it every morning, and it is what it is. And never better, Wade.
Yeah, I don't think I'll ever do that. I don't even like getting into like a 80-degree water. So cold plunge is out of the question.
We'll see. For today. All right. We don't have limiting beliefs in this podcast. So, all right. Why don't we kick it off? I will do my best to put the first question in the bank, and we'll knock it out. So the first question, here we go. Do you have advice on creating a detailed plan about how to build investments into your retirement income optimization map? That's the RIO Map. I am trying to map future assets and liabilities in a realistic way. Income from my family's defined benefit retirement plan, annuities, and Social Security monthly projections are relatively straightforward, but I'm struggling with projecting investment assets into the RIO Map. I am currently aiming for extremely low safe withdrawal rate of 3.15%. Given my asset mix based on historical data and because I want my projections to be conservative, how do you think about projecting the future income? That's the first parter. Also, if possible, can you briefly touch on some strategies you would implement to reduce sequence of returns risk in a model using this framework? Another question. Then, specific actions or guardrails to implement in the RIO Map in anticipation of the first 10 to 15 years of retirement would be appreciated. So that's to address the fragile decade. I'm familiar with some of your writing, so an in-weeds level of detail would be great. Thank you for all that you do. All the best, especially to you, Alex, and not Wade. Ben.
And the question was addressed to you, huh? Yeah, that's a good question. It's an example of one of the, not the longest question we received, but it's the longest one we'll look at today. The others, just for the sake of being able to read through them, were a bit shorter. But yeah, there's a lot to unpack here. And maybe we should start with just reminding everyone what the RIO Map is, which it's just a visual presentation of how I like to think about retirement income. You've got the 4L financial goals on the left, the longevity, lifestyle, legacy, and liquidity. You have the liabilities on the right that are mapped to those goals, the essential spending, the discretionary spending, legacy, and contingencies or spending shocks. And then you have three types of assets for the planning process. You have the, I'm blanking on reliable income, of course. Reliable income, the diversified portfolio, and liquidity for the unexpected spending shocks. And it's a visual representation that we use to then move into the funded ratio. And I think a lot of what we can discuss with this question relates to how to think about this in the context of the funded ratio, at least the first part of the question.
Absolutely.
Okay, so in that regard, yeah,
Oh,
I
you
mean,
wanted me to do it? Did you want?
yeah,
Were you
that was
handing it
my
off
way
to
into
me?
you talking.
No, you're on a roll, man. You're on a roll. No, sure. I mean, to bring it into a funded ratio, what Wade said is effectively he's looking at he's looking at assets and liabilities being future spending, right? And from that standpoint, what the funded ratio does is it's a big division. It's assets divided by liabilities, which is how pensions and companies and that's how they decide how they're gonna, if they're funded or not relative to their future liabilities. So we feel the funded ratio is a perfect first step towards really getting a sense of how you want to strategically allocate your balance sheet in preparation for doing what this person wanted to do with regards to their plan. Now here, go on, Wade, while I look
Well, and
for
before
another question.
as we get into this, so we do with Retirement Researcher, the periodic retirement income challenges. We'll have the next one, I think, in the last week of February, and
No,
that'll give you
it's first of March, probably at this point.
1st of March. It'll be coming. We haven't announced it publicly yet, but it's coming soon. And you do get week-long access. We have a tool to do the funded ratio. So as we're describing this process right now, just keep in mind that you can have the opportunity to take a look at this. But it's an effort to quantify the RIO map, the retirement income optimization map. And Ben's thinking about this right in terms of looking at reliable income, Social Security, pensions, annuities, bond ladders, that sort of thing. And with the funded ratio tool, we show you, do you have enough reliable income to meet your essential expenses? And then we look at diversified portfolio matched up against the discretionary goals and legacy. And it's all based on getting into, I mean, this question is getting into the idea of investment risk and so forth. The funded ratio is based on, do you have enough assets without taking market risk? If you just earn bond-like returns, do you have sufficient assets to meet your goals? And if you have a large enough diversified portfolio, which with interest rates where they are, if you're looking at a 3.15% withdrawal rate, that is below the, you can safely support that with bonds in the current kind of interest rate environment that we face, you'll find yourself overfunded. And so then you can think about how much of that portfolio will you allocate to the lifestyle goals, to the legacy goals. And then you may also be able to reposition some of that portfolio into reserve assets to deal with spending shocks as well. And that's really the first step in understanding like what sort of risk you want to face. I mean, when you think about what's my asset allocation going to be, my ratio of stocks to bonds, part of that is based on your risk tolerance, is how comfortable am I with market volatility? But part of that is based on your risk capacity. How much risk do I even need to take? If I can safely meet my goals because I'm overfunded by primarily using bond investments, then I can think about, well, do I want to take market risk, or how much market risk do I want to take? Or do I want to lock part of that in to make sure I've got those spending needs covered and then invest the remainder with a more aggressive approach? But that's really how to start thinking about the first step of asset allocation, is just understanding, is market risk even needed? And that's what the funded ratio tool is designed to do.
And what I would add in terms of that first part, and this is the framing in which it was asking, and we get this as well. This phrase, I am currently aiming for an extremely low safe withdrawal rate of 3.15, given my asset mix based on historic data, and because I want my projections to be conservative. A couple questions that statement arises from me. The first is, if you have previously, you stated you have pensions and annuities and Social Security, and so I'd ask myself, how much of those income sources are funding your essential expenses? If it's a significant amount, then are you doubling up, quote unquote, on the conservatism on your portfolio, right? Because at the end of the day, you can't take this with you, and you don't want to spend a good, let's say you retire at 65 and you got until 95. You don't want to spend a good 20 to 30 years just sacrificing for not, when you have essential expenses covered. And so I would kind of rethink that a little bit. The other piece is based on historic data and stuff like that. Historical data is fine, but I think you got to look at what the current environment is signaling going forward, rather than just being overly reliant on historical data, because that's just what happened back then. I mean, you get measures of central tendency and things along those lines from the historical data, but I think you can project without like trying to time the market and be more realistic about things. That's from the first part. Do you agree with my interpretation of that first kind of statement that that person made?
Yeah, absolutely. In terms of with a defined benefit pension, annuities, and Social Security, I don't know what the spending goal is, but it's quite possible you have enough reliable income to meet your essential spending, which gives you risk tolerance. Your lifestyle is not as vulnerable to a market downturn because you have all this reliable income. And in that regard, there's two ways to be more aggressive in face of this capacity. You can spend more aggressively, or you can invest more aggressively. And I think that's the point you're getting at with,
Yes.
you don't necessarily need to use a low withdrawal rate from the investments if you already have all this reliable income, because you have the capacity to potentially spend down your portfolio in the face of sequence of returns, risk, and so forth, but not have it disrupt your retirement in a truly disastrous type of way. So,
and that gets to the second and third part of the question, which is, I think they're similar statements, which is, how would you go about reducing sequence of return risk using this framework? And then what are guardrails to implement, in within the RIO Map within the first 5 to 10 years of retirement. So effectively, I'm entering the fragile decade. How do I, ease into this and not mess myself up? I'll start it off, and you can finish it off here. If you look at the RIO Map, this is kind of a little bit of an extension to then our previous statement, which is, if you're funding to the degree possible essential expenses with reliable income, and reliable income is not a sustainable withdrawal rate. There is no safe withdrawal rate from a volatile portfolio. There just isn't. Marketing won that game by calling it safe withdrawal rate, but it is what it is. The reality is, you want to see what you have, how much of it is matched, within that, and then from there you can do certain things to kind of ease into it. Wade spoke about a glide path portfolio, which is in effect, it's almost like a undercover bond ladder strategy, and that should give you some sort of buffer. Not buffer's the wrong word in the way we use it, but that should give you some sort of comfort in knowing that if, when you start your retirement and things go sideways, well, you have a higher than expected bond allocation that should dampen the volatility. Now, because you already have, though, again, the pension and the annuities, maybe there's no need for it. There could be a little bit of an overkill here. But wait.
Yeah, that's so, like, how do you manage sequence of returns risk? At the end of the day, I talk about there's 4 basic strategies which have a lot of subcategories. The one is just using a lower withdrawal rate, which I think is where this question is starting from. But you do have other options too. You can have variable spending. So if you just build in this idea that I'd be comfortable cutting back on spending a little bit if I do get a negative sequence of market returns, that can support a higher initial withdrawal rate, and that helps reduce some of the sequence risk because it doesn't force you to sell to fund the same level of spending in a declining market environment. You can do that sort of bond laddered approach or a time segmented approach where you have assets that are not exposed to market volatility matched to the short-term expenses. You have individual bonds maturing to cover the short-term expenses, which can give your portfolio an opportunity to recover in the face of a market downturn. You can look at different types of annuity strategies, but I think that's already pretty much covered for this individual with all that reliable income. And then there's the buffer asset idea. And I think we've had other questions that we'll get into in subsequent episodes with this series on the rising equity glide path, but also on buffer assets. And buffer assets is something outside the portfolio, not correlated with the portfolio, that you really think of as a buffer that if you get a negative sequence of market returns, you can temporarily tap into the buffer asset to cover spending without having to sell from your portfolio. And that will hopefully give your portfolio a chance to recover. Could be a pile of cash. It could be the growing line of credit on a reverse mortgage, home equity conversion mortgage, variable rate HECM. It could also be, if you've set this up in advance, the cash value of a whole life insurance policy as well. Those are examples of buffer assets that could provide, again, temporary spending resources to help manage that sequence risk in the early retirement years.
Yeah, and just to state the obvious, we don't consider like, oh, my bond allocation as a buffer asset. Just one of those things. Okay, I think we can move on. That was a great question to get us started.
Yeah, and there's a lot of questions coming in on the YouTube
all right,
live
want
as
to
well.
give some of those since they're live?
Sure, yeah. Can you talk about, the first one? So we'll just kind of look at these. Can you talk about a stock annuity portfolio being more efficient than a stock bond portfolio for supporting spending in retirement? Sure, yeah, and that actually touches on themes related to some of these other questions that we'll be looking at. But for me, going with research that I did now about 12 years ago, this idea of the efficient frontier for retirement income being more of a stock annuity portfolio instead of a stock bond portfolio, that protected lifetime income replaces bonds when you don't know how long you're going to live to have protected income that matches the length of what you need to make your retirement work. So, well, that's the basic idea, that the efficient frontier for retirement income, to the extent possible, we're not thinking about annuities as stock replacements. And one of the other questions we'll talk about later today gets into that point in more detail. You think of annuities more as bond replacements, that they match the spending you need. If you live a long time, they give you more income. If you don't live very long, you don't get as much from the annuity, but you didn't need as much in that scenario anyway.
And I would say high level, why is this research turning out like this? It's simply, if you think about it, the expected returns from bonds are the bond yields, right? Whatever that bond yield is relative to the maturity. With annuities, insurance companies effectively take your money and reinvest it in bonds, right? They can do it on an institutional level, so there's some benefits, and maybe they can squeak out an extra basis point here and there. But because they're able to pool your mortality and base their liabilities on average lifespan, there's a little bit of a bump. There's a mortality premium that they can present, so they can provide higher returns, through pooling everyone's mortality. And so that is where, in essence, the extra bump comes from. And so if you have similar investment characteristics as bonds plus a mortality premium, then it's very hard to, on a numbers basis, show how a basic plain vanilla annuity isn't as much, if not better, from an income standpoint than bonds from an income and efficiency standpoint. That's really high level where it's coming from. Did I miss anything on that one, Wade?
No, and it also ties into the previous question too, that when you have that reliable income, I really like to think about that as part of the bond portfolio. Because if you look at the present value of these income streams, they are very bond-like in nature. And that just then means with your remaining investment portfolio, it could be invested more aggressively because you'll have all these bonds on the side as well, in addition to the portfolio.
Okay. And then, and incidentally, as we're getting write-ins, please don't write like a lot of text, simply because we can't spend 30 seconds reading it and digesting it and trying to think of a quick answer. Just
the
Cliff
YouTube Live
notes
questions.
at least on
Short.
YouTube Live, Cliff notes as much as possible. Just dragnet, just the basic stuff. So here's a perfect, type of question. What are the thoughts about buffered ETFs as an investment? You want to go first, Wade?
Yeah, that actually ties into one of the questions we had planned that came in beforehand too. That was, so buffered ETFs are the cousins of fixed index annuities or registered index linked annuities. And so we got a question on the annuity side of that, but this would just be the investment side. I think there's potential there to provide an interesting play on the risk return trade-offs for a retirement portfolio, like a buffered ETF. To just explain real quickly, if the buffer is zero, it's going to act more like a fixed index annuity, where you wouldn't be able to have a negative return, and then you get some portion of upside, but not the full market upside potential. If you have say a 10% buffer, then if it's linked to some external index, say the S&P 500, and it's linked to the price returns, not the total returns. But if the price returns on the index, that would be excluding dividends. If the price returns were negative, the buffered ETF with a 10% buffer would eat the first 10% of losses. So say the S&P 500 ended down 5% for the year, you'd be credited with 0. If it was down 15%, you'd have a 5% loss. So it does take away some of the downside risk. But in exchange, it may have a cap where if the cap, say 20%, if the price returns were 30%, you would be capped at 20% as a gain for the year. If the price return was 10%, you'd get the full 10% of the return. So it's compressing, it's changing the dynamics of upside and downside, pulling that in closer. David Blanchett did publish an article where he said a 10% buffered type product approximates a 60-40 portfolio. So instead of, it's kind of like a 60% stock allocation instead of being fully invested in the underlying stock index. And I've been able to develop similar results to that. And so I do think it's an interesting tool that it fits more in the risk wrap quadrant, and then potentially thinking about the role, especially with like a 0% buffer as a bond alternative in other quadrants as well.
Wade, what did you mention it at the beginning? What makes it a cousin of those structured products that insurance companies have, as opposed to, you know, a closer, like a sibling?
Well, maybe sibling is a better term. It's just the underlying return structure is quite similar, but one is an insurance product and the other is a investment like mutual fund or ETF.
So what benefit or non-benefit does an insurance product have versus just buying it off the ETF?
Well, the insurance version of it can always be annuitized, but people rarely do that. But it could have a lifetime income benefit, and that's where looking at a fixed index annuity or registered index linked annuity with a lifetime income benefit gives you the risk pooling and mortality credits as well. And then in the insurance framework, you do get tax deferral, but you don't get the long-term capital gains treatment. So there's some tax differences as well.
Okay, perfect. We got a question about long-term care insurance, but I don't, I appreciate the question. It's timing in life is everything, right?
Well, when we get through these Q&As, we are planning an arc on long-term care. So we'll address that question in depth in coming episodes.
Okay. Then let's go back to the questions that we gave out to our readers this weekend, just to, do a little dance here. 80% of essential living expenses will be covered by pension and Social Security. That's great. How should having those guaranteed annuities impact the way I look at allocating investments to fund the remaining 20+%? I'm reading Wade's book, and it is very helpful. Thank you.
Thank you.
That was Mary Beth Fow.
My mother. Great question. And I addressed it a little bit. There's two opinions about this, and I addressed the opinion I take, which is you can treat that as part of the bond allocation, which allows you to invest more aggressively with the remainder. The other opinion about this is you don't, you just kind of ignore the reliable income sources. Whatever you look at the investment portfolio in isolation, and whatever your risk tolerance tells you is a suitable asset allocation based on your ability to stomach short-term volatility, that's what you'd go with. So it wouldn't matter if you had no Social Security, no pensions, or if you had all your expenses covered by Social Security and pensions, that wouldn't impact your asset allocation. Again, I'm saying that's not my preferred approach. My preferred approach is if you've got your expenses covered for the most part with reliable income sources, if you want, it's not needed, it's not essential, but if you want, you can invest more aggressively with the remaining investment assets for that reason.
Yeah, what you find here is ultimately you're doing great. I think anything over 70% is like amazing, and 70% is great. So you're beyond that. So congratulations. I think it's the phrase risk is a preference. At that level, Wade's getting at how do you frame your allocation? Do you look at the household allocation, or do you look at it in individual slices? And this goes back to even the RISA, really. If you're a time segmentation person or something along those lines, you'd probably tend to bucket these kind of views of the allocations. And that's where Wade was getting at, like, look, I want to make sure every single bucket is doing well independently, right? I think a more efficient way, if you can stomach it, or if you have the sort of the framework in place and the right temperament, is to look at it as a household, and you kind of have a license here because of how your income is set up to really do what you want. You have a lot of preference here, so I think you're good either way. But our own proclivities are, you have room to run on the investment side.
Mm-hmm.
All right.
There are
okay.
a couple more live questions coming in too.
All right. Filter them in.
Yeah, one of them is, can you discuss how far in advance of retirement should you do annuity planning, such as for a QLAC or a SPIA to be set up? And we've had a few questions about QLACs, so we will talk more about what that is in general. But specifically for this question, how far in advance? I generally say, like as a rule of thumb, about you can wait until retirement before you start thinking about it. But if you're planning in advance, about 5 or 10 years before retirement, if you're much further than that, you may not really know when you're going to retire in large part, and it's not necessarily going to be tax efficient to have an annuity start paying you while you're still working. So like in my case, I am interested in a QLAC and a single, well, QLAC's a little different, but a single premium immediate annuity, deferred income annuity. But to the extent that I don't really know when I'm not going to have sufficient labor-related income coming in, I don't know when I should have those payments start. And so in that regard, it's really too early to plan for that. But once you start getting within 5 or 10 years before retirement and you're becoming fairly sure about when you plan to retire, that could be a good time to start thinking about it.
Okay. Another question here about your sartorial preferences here.
Yeah,
he's representing McLean Asset Management. I was telling my kids as I sent them off to school, I've had this sweater since I think my freshman year in college. It must stretch because I've definitely gained weight.
It's an antique.
Yeah, right. But who sent that question? Alan. No, 30. What the hell? But Alan, yeah, man, we got tons of swag. Wait till you see the caps. So here we go from Mike. And wait, I don't know what you're thinking is. We have questions on that came in, but the live ones can take us through this session, and then we'll just knock these out.
Yeah.
On like, okay, so since these are live, kind of, I don't know, there's a little more energy when they're live. So have you seen Professor Stott already when they begin like that? No, I've never seen any. But have you seen Professor Scott? I can't. It's a little too small on my screen. XYZ. Scott something. Research demonstrating Cedarhurst. Research demonstrating that a 50-50 U.S. exUS all equity portfolio beats a stock bond or a target date fund in both accumulation and retirement. Very interesting. Wade?
Yeah, and we had questions about that same article come in too as part of this backlog of questions we're working through. I've not read the article, and so I don't know if it really has anything truly interesting or new in it, but this general idea that all stock portfolios beat more diversified portfolios is not necessarily a new concept. It's something that you see over and over, and certainly have observed it in my own research as well with different countries' data and so forth, that there's sequence risk with stocks. But generally, when you look at historical data, whenever the stock market has gone down, it recovers quick enough so that an all stock portfolio might still meet the spending goal and support a higher legacy than a diversified portfolio. That sometimes leads people to the conclusion that retirees should hold 100% stocks. If you're very probability based, you might ultimately go that route. Not everyone's going to be comfortable with that sort of approach. But no, certainly it's not really a surprise or a new thing that high stock allocations outperform other equity allocations. But in terms of what else that article has, it's a very long article, so I did not actually read it yet, but I have seen. I just don't know if it has something new or if it's just really rehashing past results.
Yeah, what you see is in these kind of things, they kind of go in cycles, right? Like, okay, this guy may get his 15 minutes of fame, and then it disappears, and then 7 years later, someone writes
Yeah.
something very similar, and that kind of thing. Look, the way I would look at this is really just take it with a grain of salt. The way Wade said it, at the end of the day, there's a very famous article written a while back by I forgot who, very very famous guy, but falls on deaf ears for me. Why not 100% equity, right? In terms of a portfolio, and the joke was because over the long term stocks go up, so why not just go all in? I think it's a preference. On an accumulation standpoint, I can be a little more sanguine about that kind of option because I'm working. I have human capital. I can work. I don't need the income. I can just always accumulate, put it in, put my deferrals in, and when the stocks go down, it's actually a good thing from a dollar cost averaging perspective. But as you retire, you have no more human capital. You have no more fallback on, if anything to fall back on. And so this is becoming a retirement paycheck for you. And the reality is it's just not a safe thing to do. It's not necessarily prudent. I mean, yes, over the long term, stocks go up. Everyone gets the math, but the path that it takes to get there is a bit circuitous, and it's not necessarily aligned with your yearly liabilities. And then that's when you run into problems.
Well, and
And
this actually, it does align with my answers to some of the earlier questions too about if you have plenty of reliable income, yeah, you can be 100% stocks with the rest. And the reason to say that is this point that 100% stocks tends to outperform lower stock allocations. But if you don't have that reliable income and you're dependent on that portfolio, even though on average, and even most of the time, the 100% stock allocation would do better, it does create more shortfall risk, more downside risk, and you just have to assess whether you're comfortable with that. And just behaviorally, it can be hard for individuals as they age to maintain 100% stock allocation. So even if this is the truly rational answer about asset allocation, you do have to consider whether you can stomach the volatility that might generate as well.
While you're taking income, it's not just because the stomaching volatility and the accumulation is different than stomaching volatility during the accumulation when you're dependent on their paycheck. But again, based on your RISO profile, maybe you have essential expenses covered. Maybe your income protection, and you're just looking at this, as a surplus. But if your total return and your only total return as your strategy, I would caveat those studies because you don't have human capital anymore, and that's the difference.
And you're right about these studies recycling. I remember even maybe it was
all the time.
10 years ago, there was one about how you should actually leverage your, be 200 or 300% stock allocations. And it's the same concept. It's because on average, you do better that way. But again, it's a risky strategy.
Yeah, you see it all the time. I mean, the recent outperformance of U.S. versus international is you're going to see studies on, is the international stocks even needed? Are international stocks even needed? Et cetera, et cetera. It is what it is. So let's see here. What else do we have?
Yeah, we're getting lots of these live questions. We might even, the pre-planned questions we had, we may just save for the next episode too.
We'll just save it for the next episode because if people are live, I'd rather try to kind of like.
Yeah, so the next one on the list is we want to defer Social Security until one of us is 70. The cost to do so will be about 20% of our savings. Is that a reasonable expense to maximize Social Security? Based on research I've done, yeah, I certainly, that's the idea. In the short term, until you get to 70, you're going to be spending down your other assets more quickly. But then after age 70, your Social Security benefit is so much higher that reduces the distribution pressure on your other investments. And so if you live to at some point in your 80s, probably you're going to start to be better off with your remaining investments, even though you spent them down more quickly. After age 70, the less pressure there is on those investments. They're going to have more opportunity to recover, or at least not decline as quickly. And in the long term, you're going to be able to leave a larger legacy with the Social Security delay. So Social Security delay doesn't work if you don't have the resources to fund the delay. But I do think that just 20% of the savings is within a reasonable range of, yes, that can be okay if you're someone who is planning for the possibility of living into your 90s. you're likely to still benefit from a much larger legacy or more assets remaining at the end of that retirement by having delayed Social Security, even though in the short run, you were accelerating the spend down of those assets for a while.
There you have it. Here's another one here. Critics of factor investing, and then in parentheses, for example, okay, value stocks, small value, etc. Critics of factor investing recommend holding international for diversification, but rarely in proportion to world cap weightings. Seems hypocritical. Thoughts? Okay, I'll start. I'll start this one off. I don't know if hypocritical is the right word, but I know what you mean here. Effectively, listen, if you're into passive investing and the markets, the markets in aggregate have all information and it's reflected in prices, then you can make the case, a strong case, that in that line of thinking, your equity portfolio should just reflect the world equity portfolio, because that's how the world chooses to allocate their assets in aggregate. Any deviation from that is quote unquote a bet, right? That kind of thinking. Where I would say is you should hold that global representation of stocks to the degree that you consider yourself the aggregate average investor. And so once you put that up against that assumption, it kind of falls apart, quickly, in terms of why don't you hold what the world represents, right? The first one being that we're in the US. And so you spend money in the US. And so it's much more valuable to overweight that accordingly. And simply put, there's a lot of moving around as well, and so where I would say a few years ago, the world represented, like, it was split world US like 50-50, roughly speaking, right? In the low 50s, with the tip of the hat towards the US, where in the 80s, a lot more US than, recently, then it was like 50-50-ish. Now it's well over 60% US versus international. And you're not going to be moving around, bumping around just because of that arbitrary sort of composition. So just because, I got to hold the world assets, you're not the average investor. That's a good enough reason to deviate relative to you're not making market bets, right? Now you can make the same case. What about with bonds and things along those lines? That gets a little trickier, and even backtracking with equity a little bit. The reason to diversify, to me, with international stocks is you have a greater sample, a greater representation of which you can capture market returns. So why not capture them, right? Why not do that? And I don't think you need to have point blank look at global and domestic and be like, okay, I'm at 60%, so I got to match 60%, or the world is at 55, let me go down to 55. I think really you get a healthy slug of it and you're in good shape. For us, McLean, where Wade has that beautiful jacket, effectively we're 2/3, US to international. Why 2/3? It's a good round number, frankly. It gives us a healthy dose of it, and it gives us good representation of potential market returns across the globe. Why aren't we, whatever the exact number? Because it doesn't matter, and I don't think we're necessarily, we're passive investors. We're not necessarily being hypocritical or not. But I think it has to do with how representative they are. Now, when it comes to fixed income, that's a little bit of a different ball of wax. There's less randomness there. And so you don't need to diversify. And by randomness, I mean, like, the bonds are kind of known. The expected return of the bond is what the yield is, and you just do the math on that and you can figure it out. So there's less randomness to be had there, or extra returns to capture from a diversification standpoint. It's a little more muted from that perspective. So you have that, as you don't need to sort of do as much. The other piece is the currency risk. If you introduce currency risk within your bonds, those things can go all over the place, which then defeats the purpose of being in fixed income anyways. But there is something to be said for having, if you go international and if you can sort of hedge for currency, then, dip your toes in a little bit, assuming it's high credit, et cetera, et cetera. You can do that, but I don't think there's any need to be robotic about following the global representation of that, for the reasons I previously mentioned, to equities, and even less so in fixed income. Hand it off to Wade.
But yeah, I do see the point of the question about this. It seems hypocritical to not want to overweight towards particular factors, but at the same time not taking the market portfolio with international. I do like to hold that world portfolio myself with the that international allocation, like a little bit under 40%, but close. But yeah, you got some flexibility, and I guess the argument in favor of not holding that world portfolio is kind of, if your liability is in US dollars, you're trying to fund expenses linked to US inflation, it could make sense to overweight to the US market. But yeah, beyond that, it's subject to some interpretation or flexibility for what individuals feel most comfortable with.
Okay. And then we'll just do these. We got 3 more, and then we'll call it on the live episode here, Wade.
So we've got
or did we?
Where can one find more information regarding the Social Security tax torpedo and the best methods to avoid it outside of listening to episode 105 of Retire with Style? Which is that the article where I talk about the effective marginal tax rate? I actually have our podcasts open here. Let me kind of in real time check what episode 105 was. Yeah, managing taxes in retirement using the effective marginal tax rate. So that's brand new content, that this idea of using tax maps. I think it really helps to understand the tax torpedo. What I've been doing this past week is updating the retirement planning guidebook. Well, by the end of the month, we'll have a 2024 edition, and I'm completely redoing the whole explanation of tax efficient retirement distributions. So I think there's going to be much better explanations of the Social Security tax torpedo in the context of these tax maps. So I would say look for the 2024 edition of the Retirement Planning Guidebook. And then as well with the Retirement Researcher, we do have workshops, not so much on Social Security for this topic, but on the tax planning and for tax efficient retirement distributions. I do talk about this in the Retirement Planning Guidebook in Chapter 10 on tax planning, and I will be significantly revising the discussion around that for the 2024 edition.
Yeah, again, not to pitch Retirement Researcher, but pitching Retirement Researcher, that's a huge education site that Wade and myself, but really like Bob French, curates it and manages it. So I definitely, if you want more info, just check that out, retirementresearcher.com. But also on that episode 105, we have in the show notes, I believe we have a link to the article. Wade, if you have it up, can you just double check that the link is up there? Because Wade wrote an article on it with, I'm going to mispronounce that gentleman's last name.
Joel Sasser.
Joel Sasser. You know what that reminds me of? That reminds me of, who was that attorney in Arrested Development?
You mean Henry Winkler's character, or the Bob Blah Blah?
Bob Blah Blah. Yeah, it's a little bit like it's a little bit like Bob Blah Blah. Anyang. All right.
We didn't say what the tax torpedo was, but just as a reminder, as you start to generate income and you have a Social Security benefit, $1 of ordinary income can also trigger tax on a portion of your Social Security benefit. And so it compounds the tax impact, where you may think you're in the 10% federal income bracket and you're paying at 18.5%, or you may think you're in the 12% bracket and paying at 22.2%. Or if you're a single person, the tax torpedo can hit you when you're in the 22% bracket, where you're now paying at a 40.7% rate. And so that's where people can be surprised at just how high the effective marginal tax rate is on their income in retirement.
Okay, and does that tie into the last question? Wait, I was reading the other question, so I didn't hear your full answer.
Oh yeah, there is. I didn't see that, but right, so what's the effective tax rate on Social Security's tax torpedo? The marginal is 40.7% for a single filer. Yeah, it depends on how big your Social Security benefit is. And this is where there's not just one tax torpedo, but for single filers, they can be running into the tax torpedo when they're in their 22% bracket. And so that's what would create the 40.7% effective marginal rate. That's
And,
not going to impact a couple married filing jointly because they're going to get through the full tax torpedo while they're still in the 12% bracket. So it'd be a 22.2% effective marginal rate.
Okay, questions keep on coming in. Wow, I didn't see that. Okay, do you recommend buying tip bonds or tip bond ladders in a taxable account for those people in retirement that don't have a lot of money in IRAs? What about the phantom income tax? Is it ever okay? That's almost like a planning question, but we have to look at that person's particular situation, right?
Yeah, I
and
mean,
then
that's
it's like that one, I bonds, and how much they're planning to put in.
But right, you definitely need to look at the individual circumstances. But if the question is just more basically, should you never buy tips in a taxable account? I would say no, there may be situations where it's fine to buy tips in a taxable account, especially if you don't have other options and you do have a time segmentation strategy or you do want that inflation protection. You shouldn't be scared away from owning tips in a taxable account. Just because the phantom income problem, which is where you have to pay taxes on the inflation adjusted principal, even though you don't receive that back until it matures. So you're paying taxes on income you haven't received yet. They're not tax efficient. It's better when you can to have tips held in a tax advantaged account. But if that's simply not an option, it doesn't necessarily lead you to conclude you should not own tips. Also, don't forget about I bonds. If you have a long runway, you do have that allocation to I bonds, which provides the inflation protection, though at a lower level than tips generally. But at least you do get the tax deferral with I bonds.
Okay, and wait, since we're 45 minutes in, and these are great questions, Brian, Paul, Jeff, etc. I think we can address this, but I don't know. What do you feel? Do you want to push through, or are we're trying to do a 45-minute limit on our podcast this season? See if we can keep to that, but I'll leave it. I'll let Wade be the bad guy.
Well, yeah, it would be nice. There are getting to be more and more the live questions, so we probably aren't going to get through them all now. We'll do them in the next episodes, but maybe at least one more question.
Okay, why don't you dealer's choice?
Okay, how about this Medicare related one? Although I haven't fully internalized it, but okay, I'm age 63, retired, not collecting Social Security, and covered under my spouse's employer health care. I always make the maximum HSA contribution every year. Should I sign up for Medicare Part A at 65 or defer? So that the issue here is, I guess we're still assuming you're going to be covered under the spouse's employment healthcare after age 65. So you have the option not to sign up for Medicare. If you qualify for Social Security, you should qualify for premium-free Medicare Part A. So a lot of times the recommendation is you may not want to sign up for Part B since you're covered through the spouse's plan, but there's no harm in signing up for Part A since there's no premium, and it would be secondary insurance if there's a hospital stay. The only downside of that is you can no longer contribute to an HSA account after you've signed up for Medicare Part A. And so if you really value...
Probably why they put that.
Yeah. So that would be why this question is. So if you value the ability to contribute to the HSA account and you don't think you get that much advantage over having Medicare Part A as a secondary coverage, then, and you have to ensure your spouse's healthcare plan, like he or she is at a company with at least 20 employees and does qualify as primary coverage for individuals that are eligible for Medicare. As long as that's the case, you may defer signing up for Part A as well so that you can continue making HSA contributions.
So I think the question here is that the break even, not the break even, but the trade-off, better said, is, okay, do I sign up for it now? And in case things go sideways, sorry. In case things go sideways and I need that secondary coverage, is that worth not contributing over the next few years to HSA? Whereas HSA will come into play in a more significant level later, and it could rule the roost. It's kind of like that's what they're asking, which side to
and
bet on.
That could also depend in part on how good that employer health plan is. Like if it has really good coverage so that you're not really worried about a hospital stay leading to big bills. then you may not need the Medicare Part A at that point as a secondary coverage.
Yeah, I think that's what I would ask internally in terms of looking inward. But all right, Wade, that concludes episode 1 for this year of YouTube
right.
Live. All right.
Yeah,
Thank
and
you,
if we didn't
everyone.
get to your questions, including the other live questions, we're going to record a few more episodes where we're going through all the questions that have been asked, both today in the live session as well. When we had that email call out for your questions, we got an overwhelming response to that. So we're going to continue to answer your questions in the upcoming episodes.
Most definitely. I think we're onto something here with just, getting more interactions with our audience members. I'm actually quite enthused. So
Yeah, and it lets us
thank you very
procrastinate
much,
on talking
everyone.
about long-term care as well. So that's another plus.
All righty, everyone. Thank you so much.
Yeah, thank you. Looking forward to a great 2024.
Bye now.